Welcome to the Dividend Talk podcast, episode 233 Dividend Investing with Dividendology. We've got a guest from the US on. It's Eli from Dividendology, and I'm really excited to have you on the show, Eli. I follow your YouTube channel, so welcome to Dividend Talk.
Yeah, thank you guys so much for having me. Really happy to be here. I've been a fan for a while, and I love keeping up with y'all's work, so I'm excited to be here.
Perfect. So just in case some of our listeners, I'm pretty sure they will, but just in case they don't know you, maybe just give a little brief introduction about who you are and what you do.
Yeah, I'll give a brief introduction about what I do, and I'm sure we can get into more later on. But so I go by, my name is Eli. I go by the name Dividendology online. At the moment, a dividend growth investor at this stage of my journey, and I kind of share my journey, my thoughts along the way on places like YouTube, Twitter. I'm also on some of the smaller platforms like Threads and Instagram. And then Dividendology.com, of course, the newsletter. There's about 30,000 newsletter subscribers that I send a weekly email out to. Plenty of places to find insights from my brain that reads probably 50 to 60 hours worth of dividend stock news a week. So I've built a little bit of a following, and I'm happy to share my thoughts along the way.
I'm kind of excited to get into questioning you a little bit, Eli, and asking you some questions. So
yeah, absolutely. Glad to be here.
Maybe let's start about your investing history. What does that look like?
Yeah, that's a great question. I've definitely one of those people who have explored a lot of different avenues. So if we go back, well over a decade, even early on in high school, when I first learned about investing, I was like, oh, this is great. My money can make me money. This is my path to freedom. So I start researching everything, reading everything I can, and I'm like, okay, real estate investing. This is my path. And it's funny because later on I worked at a real estate firm in finance for quite some time, but I quickly realized there is a lot of money to be made in real estate investing, but there's high barriers to entry, and it's one of the higher risk investments. So I quickly realized, coming out of college, maybe this isn't my best option to explore. I tried the penny stock thing, obviously lose money like everybody. You realize it's not actually investing, that's gambling. Then you explore high yielding investments. I'm like, okay, dividend stocks, 9, 10, 11% yield. This is where I want to go. And then you see the share price go down. You see the dividend cuts, and you're like, okay, is this investing thing a scam? And we've seen the dividend stocks that people recommend that have these 2% yields. And you're like, why would I ever buy a stock that has a 2% yield? This sounds like the most boring type of investing ever. But what I failed to understand at that time is the best businesses in the world are businesses that grow their earnings and grow their free cash flow every single year. And as a result, they grow those dividends every single year. So the share price is going up, the dividends are going up, but a lot of the times the dividend yield is staying the same because investors are willing to pay that price for that dividend yield because the dividend payments are growing. So as a beginner dividend investor, if you don't understand what dividend yield on cost is, you have to understand what that is before you make any other moves because it's such an important concept. You buy a stock at about $10 per share, hypothetically speaking, say it pays a $1 dividend. Obviously, that's really high. But if the next year it pays a $2 dividend, all of a sudden, your yield in year one was 10%. Year two, it's 20%. And that was not a concept that I could get through my head for way too long. And it cost me so much time. It cost me so much money. And so when I understood what that looked like, I realized this was the path for me, buying great companies, buying them and holding them for the long term and letting those dividend payments snowball over time into something that could one day cover my living expenses. So I share my portfolio online to kind of show what that snowball effect looks like over the long term. My dividend income grows, one, yes, because I can contribute to my portfolio, but two, I reinvest those dividends, and three, I buy companies that grow their dividends at a high rate. Think of Microsoft and Visa. They're raising their dividends at pretty much over 10% every single year. So the dividend growth element plays a large role in my dividend payments growing over time. It's my goal to one day live off dividends. And from what I've seen, this is the fastest way to get there. Now, obviously, as you get closer to that time where you're actually living off dividends, you do kind of want to shift more to a high yield mentality as long as those dividends are sustainable. But at where I'm at in my journey, dividend growth is just the way to go.
Yeah, and it's good that you mentioned it because I think many people, specifically, I noticed that in the total return investment community, they think we're dividend investors, and they don't understand that for us, dividend growth investment is grow first, then dividends. If there's no growth, we won't invest for the dividends. And I all the time see this discussion on the socials and everything about like, you're holding the bag, stupid about dividend investing, and what about the share price? But these things typically go hand in hand, yeah. And Microsoft is there, and Visa are typically not seen as dividend stocks; they are seen as growth stocks, yeah. But it's really dividend growth, in my opinion.
You're exactly right. And a great example I was reading the other day, and I posted a while back about this. But if you go back about 10 years, for example, Lowe's had a starting dividend yield of, I think, below 2%. And then you had Verizon starting dividend yield
Yeah.
of 4, 5, or 6%. But if you fast forward a decade later, guess who actually paid out more in dividends?
Yeah,
It was
exactly.
Lowe's. And when you look at a case study like that, your perspective gets completely shifted. And you made a great point. People say dividend investing. That's a really broad term, isn't it?
Mhm.
That doesn't tell you if you're a defensive dividend investor buying stocks like Lockheed Martin simply to preserve capital and get some cash flow. Doesn't tell you if you're seeking out high yield dividend stocks. And most people don't hear dividend investing and think dividend growth.
Exactly.
Because we're looking, number one, to buy quality companies that are growing their earnings over time, because that's what allows them to grow those dividend payments. It's really that simple.
Yeah. And to some extent, the dividend yield gives you a certain valuation. Yeah. And that's the difference between, for instance, for me, it's really hard to invest in stocks like Palantir. And I understand the power of the business. I work a little bit in this area, and I can really understand the product quality and everything. But the multiples and the fact that it was first in a loss, for me, it's really hard to evaluate. But if you go to the little bit more mature companies, it puts already a more of a defensive layer, and then the yields actually put some sanity into it. And that's what I also like. So, I mean, if a company has a 80 multiple, the yield means really nothing. And there's also maybe a question to you. How much dividend growth do you find reasonable for low yielders? What I mean to say is, like, there are some stocks like maybe Visa, they have less than 1%, maybe. I don't know exactly what the current yield is.
Yeah.
That would require maybe like a 15% yield, 15% dividend growth over the next 10 years consistently. And for me, it's really hard to predict such results, like 15%, 20% growth annually over the next 10 years. How do you look at those companies from that perspective and their ability to do this for a decade? I know that Visa did it in the last decade, but how about the next decade?
Yeah, that's a phenomenal question. And you're bringing about a point that's a lot of people make that mistake as well. They say, okay, is my investing time horizon 10 years? I'm going to buy Visa and Microsoft, which, again, some of the largest positions in my portfolio. But even at a 15% dividend growth rate, below 1% yield, you still might not end up where you want from a yield on cost perspective.
Yeah.
So understanding your time horizon, I mean, that's one of the day one things you absolutely have to understand. So with that being said, when you look at those stocks, it really is all about your time horizon. If you're 30 plus years, I think those are a great place to start.
Yeah.
And you're absolutely right. If you're getting a 1% yielder and the dividend growth rate is 6%, it might be time to look somewhere else, unless there's an immense amount of share buybacks going on, maybe heavy reinvestment back into the business. An example of that I would give would be ASML. That's a hot stock everybody's talking about. And I was reading their recent earnings report. The management team did state that they plan on hiking that dividend payment over time. Now, their projected earnings growth over the next 3 to 4 years is 20% a year, maybe a little bit above. With that being said, their recent dividend hike was just 5%. So if you can't look past that dividend hike and actually see what's going on with the underlying fundamentals of the company, that might be a red flag to you. But if you look a little bit deeper, you're like, the potential to grow the dividend over time is absolutely astronomical. Now, will that happen over the next couple of years? I don't necessarily know what management team intends. They have stated they plan on paying out a dividend and growing the dividend and buying back shares. But I care much more about their ability to pay out dividends in the future than the dividend they're paying out right now. One of the things I always say is, if you're a long-term dividend growth investor, don't worry as much about the dividend it's paying in year 1. Worry about the dividend it's paying in year 20. So that's kind of how I look at things.
Yeah, and with ASML, I would say it's very conservative management, and they did a huge dividend hike a few years ago. So I expect them to do small dividend hikes, and then once really the revenues are confirmed, maybe 2-3 years down the road, they will just bump the payout ratio again. And they're also a big fan of buybacks, share buybacks. So I do expect like not the Johnson Johnson clockwork growth, but I see this irregular growth, but growth. And overall, over a long time, I think we will definitely, no, definitely it's hard to say, but we will see a double digit dividend growth. That's really my expectation as well, because otherwise what would happen is they will be significantly just lowering the payout ratio. And I think that's not management intentions either.
Yeah, completely agree.
So then, what do you look for then when you're starting to buy a stock? What you mentioned, low yield, high yield. Do you have a particular yield that you start with? Growth metrics. What's your
That's a great question. And like I said, for each individual, it's going to start with, okay, what's my individual goals? What's my risk tolerance? And what's my time horizon? And once you have those things, you can pin down what are those metrics. Now, every instance is obviously going to be a little bit different, but for me personally, obviously, 5 key metrics I always talk about when it comes to dividend investing. We all know dividend yield, right? How much we're going to get paid. We talk about dividend growth. We talk about the dividend history, and we talk about payout ratio. When you want to pay attention to the earnings payout ratio and free cash flow payout ratio, because unfortunately, we could have a whole nother conversation about this, but the earnings payout ratio can lie to you pretty easily.
yeah.
But number 5, a lot of people don't look at this, but what's the projected free cash flow growth? If you're just starting dividend investing, those are the 5 key metrics you have to look at. If you see a history of growing free cash flow and you see a history of growing dividends, that's a great sign. Now, if you see free cash flows remaining stagnant, but those dividend payments are growing, like we just talked about with Pepsi, that's not sustainable over the long term. And that's not a knock on Pepsi. They're obviously a dividend king, have grown dividends for a great amount of time now. But you can't maintain dividend growth if free cash flow is not growing over time. So as a general basis, those are the 5 key metrics you want to look at. Now, you can get a lot deeper into that, obviously. You want to look at the underlying fundamentals of the company, what competitive advantages do they have. But as a general rule, those are the 5 metrics you want to look at.
Nice. And do you have particular starting points in each of them? Because you mentioned projected free cash flow growth over time. How do you project that, for example, for a beginner, say, investor who would have no idea how to project that?
That's a great question. So in my instance specifically, because I consider myself long-term dividend growth, I am looking for double-digit free cash flow out of most of my holdings. Yeah. Now, there is going to be exceptions to that. You could call me a hypocrite because there are some holdings in my portfolio that don't fall in line with that. But for the most part, I'm heavily weighted towards Microsoft and Visa. Like I've already mentioned, I have Broadcom, AVGO, one of the other larger positions in my portfolio. But, it's give and take a little bit. Vici Properties is also a real estate investment trust that I believe in over the long term. Now, REITs are going to be a little bit different, but we're talking about them growing adjusted funds from operation, which if you're not familiar with that term and you're listening, it's similar to earnings per share, but we're talking about a REIT, so we pay attention to AFFO. But they probably won't grow it above 4 to 5% moving forward. Now, with that being said, I don't know the starting dividend yield at this moment off the top of my head, but it's close to around 6%. So from a dividend growth perspective, you're talking about around a 6% yield and above inflation rate dividend growth rate. So maybe 6% dividend yield along with, 3, 4, 5% dividend growth. I think if they can sustain that, then that's a really good investment from a dividend perspective, even for the long term. You've already got that starting yield that's high. It's going to be reinvested back into your portfolio, combined with a pretty solid dividend growth rate for a starting dividend yield. And, it goes back to the underlying fundamentals. Vici has a rent escalation clause where essentially it'll raise at the rate of inflation. So you're protected from inflation when you buy a REIT like that. That's huge. You look at them in 2020, they collected 100% of their rent. That was not the case for most of the REITs in the US during 2020. They own real estate in Las Vegas. It simply can't be replicated in Las Vegas. If you look at the tourism numbers, it's skyrocketed. They hosted the Super Bowl. I can't remember if it was last year or a couple years ago. But you get the point I'm making. There's underlying fundamentals about each of these companies that you can make the argument, for whatever reason, maybe their numbers could look a little bit different than what you'd expect from your portfolio. And I think that's an example of that in my personal portfolio. So to go back to your original question, it kind of depends. I hate to say that.
Yeah.
But as a general rule, I'd love to see the starting dividend yield be at least 1%. But if that's the case, dividend growth needs to be at least 12, 13, 14% in most cases. Once you start getting to around the 3% yielders, 7 to 8% dividend growth is pretty good. And as a baseline, I at least want to see, if I'm buying a high yielding stock, dividend growth that beats inflation. Another mistake a lot of people can make is you make that move into higher yielding investments, maybe with the intention of living off of them. But if their dividend growth rate is, 1%, well, inflation over the last few years, I don't even know off the top of my head, if it's 3, 4, or 5%, your purchasing power is going down every single year. So it might feel like you're making the same in dividends, or maybe even a little bit more, but your dividend income is really shrinking in the grand scheme of things. So dividend growth, no matter what stage of the journey you're at, it's something that you really want to see at least above the rate of inflation as a baseline.
Yeah, that's really important. And otherwise you start just eating up indeed your own bills. And there's this income factory approach, which is about buying high yield stocks and using reinvestment, because you have kind of a guaranteed yields, or guaranteed between quotes, right? And therefore also return, because you can reinvest it. But for me, that works really well probably in the accumulation phase. But then, if you want to grow your income after that and the dividends are not growing, you're really into a different situation. What you say, I like to really always use the chowder rule in my head. So if it's a 3% yielder, like 7 to 9%, I would expect, to your point. If it's 1% yielder, it should be 11 to 12%. Generally, I've got my rule to be around 3%, 3.25 on average, and 6% growth. But I own Microsoft, I own Apple, so it's more about the mix here. So I combine a little bit higher yield with lower growth. And my time horizon is still like a few years, let's say. That's about it. And then I should be really able to live off dividends. But what is your time horizon at the moment when you think about, have you ever calculated for yourself this financial independence target?
Absolutely. Do it every month, actually. I release monthly portfolio updates over on YouTube. So if you want to take a deeper look, obviously you can look there. But at the moment, based off projections, I believe I'm 13 to 14 years from being able to achieve living off dividends if I choose to do so.
Okay.
Obviously, plenty can change during that amount of time, but that's where I'm at right now. So technically speaking, I would be at a stage where a lot of people might consider, slightly or slowly moving into, a medium yield phase.
Yeah.
But I think I just really, a few different things. I love my work. I love what I do. So that being said, I'll probably continue to focus on the dividend growth aspect to really maximize dividend income over the long term. But as far as actually being able to live off dividends based off projections, I am about 13 to 14 years away, which is exciting to think about.
And that's maybe also a question, like, how do your friends and family generally respond to your investment journey and what you try to do with it?
Yeah, I think it's a little over their head most of the time, to be honest with you. I try to explain it's really not too complicated, but at the end of the day, find a way for your investments to cover your living expenses and sustain that. It's that simple. But we all know it's not actually that simple. It's quite a bit more involved than that. But no, they've been encouraging. Investing in my family was, I guess you could say I'm a first generation investor. Let me put it that way. It was never a primary focus on either of my parents' side. I didn't have any siblings or any cousins really encourage me along the way. It was just more of a realization at a young age that, wow, my money can make me money. That means that one day I could not have to work. That was foreign news to me. I didn't realize that was an option. But hopefully it's been an encouragement to those around me, I would say, just to realize the possibilities that are around all of us with, the investing tools that we have now. I don't know what it's like in Europe. I'm not sure if it's quite as easy as it is in the US now, but obviously we have, no commission trading. I don't like the word trading. No commission investing. You can do it from clicking a button on your phone. I mean, we all have such easy access now. There's really not any excuses. The only excuse you can make is, I'm not educated now, but I'm going to be educated soon, and then I'm going to make it happen. So hopefully it's an encouragement to those around me.
Nice. Yeah. So we have also all the access in Europe. We don't have access to SCHD and those kinds of ETFs, maybe via some workarounds there. But it's nice that you say like a first generation investor, because I think that applies to most of us. And we did the other day in the Netherlands, we met for a dividend day, and the amount of people that were saying like, oh, finally I can talk with someone about dividend investing. That's really, really interesting that our environments are just totally focused on other things. And I would say if you discovered investing already on a relatively early age, then for me you won the jackpot. I mean, I won the jackpot in my early 30s. That's how I see it.
Yeah, we all wish we started 10 years earlier than we did. But if you're starting at that age, yeah, I think you're quite a bit above most everyone. So the best time to start obviously was 30 years ago. The second best time to start's right now.
Exactly.
I always say.
So I'm curious about your YouTube life. What kind of inspired you to start YouTubing about dividends specifically?
Yeah, so really when I started out, I was just making videos on financial modeling. Just something I've always really enjoyed, thought was super interesting, valuing stocks, how to build out portfolio trackers, how to, use different valuation models. And I think they were helpful videos. I got a lot of comments saying they appreciated the videos. And I was like, well, I'll keep doing this, but I also kind of want to share my own journey and what's going on with my personal portfolio. Turns out there's a lot of people out there who that was a big help to. They loved seeing somebody else's journey over time. What are the moves they're making? How is real money being invested? One of the problems that we have is we just don't have access to people that are transparent with their money. And that's understandable. Obviously, it's a touchy subject. It can look so different for everyone. But there's so much you can learn from seeing not only the good that people do, but the mistakes. I've been sharing every single month the moves I've been making for over, I think, 3 years now. And I've made mistakes during that time. I've made mistakes in public. I've talked about the mistakes I made that I've shared with you guys already, focusing on the high yielders, stocks, penny stocks. You can learn so much from the mistakes just as much as the success that people are seeing. And so people see my portfolio now, and not that I'm somebody who has it all figured out, but I think sometimes they have a harder time relating to it. But what I would tell them is just go watch my videos from 2 to 3 years ago when I'm starting at a much lower number. And I'll tell you, you can probably relate to it quite a bit easier at that point. So yeah, I just always loved sharing my journey, sharing my knowledge. And as my knowledge has grown, I think it's been able to help more people. I never really considered myself a YouTuber. I just considered myself somebody who liked sharing my thoughts. Didn't know all the tech savvy tricks. I just knew how to talk about dividend investing. Unfortunately, there's other people who enjoy hearing about it.
And does it take up much of your time? I know you've quite a large following on there, and you release a lot of videos. So, like, what kind of role does that play in your life?
Yeah, it takes up a lot of time, no doubt. I'll be completely transparent about that. But the thing is, I'm sharing my thoughts on my research and my analysis. And that research and analysis is something I would be doing either way. Even before I was sharing my thoughts on YouTube, I was doing that same research and analysis. And that's probably what takes up the bulk of my time, 40 to probably 60 hours a week. I've never really calculated, maybe more, but it's an everyday thing. It's not work if you enjoy doing something like that. And so really just boils down to sharing my thoughts after I've done that research, after I've done that analysis. But absolutely no doubt, it takes up a whole lot of time. So I don't want to give any false narratives there.
So it's not as glamorous as everybody makes out to be.
No. Well, I mean, it depends. I'm sure if you're Mr. Beast, then
yes.
the money probably makes it worth it. But if you're going to do it for the money, then I'm afraid you might be very disappointed.
But did it open up any other opportunities for you?
Yeah, I get to be on cool podcasts like this one right here. I've written for Seeking Alpha some. I've had some people comment that hey, I love watching your YouTube videos. I've gotten to talk to some cool people along the way, just connections I've made, on Twitter in the YouTube space. I was on a podcast for Seeking Alpha not too long ago. Got to meet some cool people over there with their team. So it's just cool to make connections with like-minded people who, are interested um, just in investing in general, whether it's a different strategy or methodology than the one I'm exploring. There's so many people putting so much work and effort into, democratizing investment research.
Yeah.
It's cool to see that trend and just the growth that we're seeing kind of in this media space per se.
Yeah.
Yeah.
Of course, you've got ticker data then as well, which probably
Right.
came off the back of YouTube.
Yeah. So, like I said, I've done a lot of spreadsheet modeling, financial modeling. That's what I was sharing originally on YouTube. And the most frustrating thing is having to copy and paste data into my spreadsheet all the time for each stock that I look at. So I actually had a software developer friend in college, and I was like, hey, I think we need to put a tool together that can really automate that process. So we put years of work into it, and ticker data was born. So if you're not familiar, ticker data is basically a Google Sheets spreadsheet integration that allows you to automatically import stock financials into your spreadsheet. And so if you see any of my spreadsheets on my YouTube videos, on Twitter, pretty much anywhere, it's a ticker data spreadsheet. So basically you input a stock ticker and all the data is going to automatically load in. And one of the things that was really important to me is, half of my audience is international. So I needed the data to be able to work with European stocks, with Canadian stocks, Australian stocks. And ticker data, we're super proud, has the capability to do that for, I think, over 70 different stock exchanges. So I didn't even want to build anything if it wasn't going to be possible for international investors to use it. But it's been a very helpful tool. We've had, thousands of people use the tool. So we're really proud of what it's become. It's got a long way to go. We're adding new features constantly. But it's a tool that I needed, so I knew other people needed it as well. So it was a great market fit. I use the tool every single day. I'd be using it even if, I didn't have the YouTube channel. So definitely a long way to go with where we want it to be, but it's very helpful tool and exactly what I needed just a few years ago.
Awesome.
Awesome. So maybe let's get back to dividend growth investing. And I'm curious to hear what your biggest learnings so far is.
The biggest learning is you don't start with the dividend, you start with the underlying fundamentals and the quality of the business. And as hard as that is when you're starting out and you see those dividend payments coming in, I bought AT&T stock and I actually did make a gain on that purchase. Believe it or not, most people did not who have bought AT&T stock, but I quickly realized, this is not the type of business that I want to be in. Not a lot of competitive advantages. There's the margins don't look great. They're struggling to cover the dividend with their free cash flow, and they did end up cutting the dividend as a result. Compare that to, people are going to get tired of me saying this. Compare it to Visa, though. Visa is just the easiest example to look at. A company that uses maybe 20% of their free cash flow to pay out a dividend. We talk about that, but what's the flip side of that mean? Well, it means 80% of their free cash flow is not being used to pay a dividend. So what are they doing with that? Yes, they're using some of it to buy back shares, but that means that the majority of the free cash flow is being reinvested back into the business. So what's the end result of that? Well, if you reinvest billions back into the business, if it's a good business, which Visa is, you're going to be able to generate higher levels of return. And, that's where the term return on invested capital kind of comes into play. What kind of return are these businesses getting for the capital they're reinvesting back into the business? So, two key metrics we want to look for that kind of indicate whether a company is quality or has a competitive advantage is one, gross margin. Visa's sitting very high. And then return on invested capital. What kind of return can a business get from the capital that's being reinvested back into it? And if you look at a company like Visa, both of those are very large numbers. And, as a baseline, you want to see return on invested capital at least 10%. Visa has been above 20% for the last few years. So if you're looking for a place to, start to spot or maybe screen for quality companies, return on invested capital and gross profit ratio, great place to start. I will say there's exceptions to every rule. Obviously, Amazon's not going to have a gross profit ratio that's super high. but the revenue's so high, and it's growing at such a high rate, not really as much of a concern for a business like them.
And then what about your top 5 dividend growth stocks, if you have to
Top
pick?
5 dividend growth stocks. Oh man. Well, I was looking at a list of 10 stocks that your audience provided, and I actually agree with quite a few of their picks. So my top 2 holdings, like I've mentioned already, Visa, not going to harp on them anymore because I've touched on them, but then Microsoft. Microsoft's been growing that dividend for quite some time now. People still don't consider it a dividend stock, but if I remember correctly, from a total amount paid out, I don't think any other stock pays out as much in dividends as Microsoft pays.
It's crazy in
It
billions.
really is.
Crazy.
And you think it puts into perspective just how quality of the business that people are willing to pay that much for the stock, $410 per share, for a stock that's yielding around 1%. And the business still pays out more in dividends than anybody else. So, well, my top 2 stocks would be Microsoft and Visa. That being said, I'm a huge fan of Broadcom as well. Got in pretty early on that one, and it's obviously been a huge return on my investment. Just even from a share price appreciation standpoint, I think I'm up over 300% on that stock. Now, let me pause myself before I keep going. The top 5 best dividend growth stocks is, again, going to depend on your individual scenario. If I was 2 years away from retirement, I would not be saying Visa and Microsoft are my top 5 dividend stocks, right?
Well, you say that, but I'm looking at my portfolio. Microsoft is number 2 for me with a 7.1% yield on cost.
That's a great point, because you got in early and you've let compounding do its thing. Your yield on cost looks amazing.
Yes, and I got
quite good.
And I got in at a 2.75% yield because this was just when Satya Nadella was in for 1 year. And I remember on Seeking Alpha, Microsoft is dead. Who wants Windows? Who wants laptops? But I had this insight probably from working in the IT industry that the cloud is coming up, and I couldn't see how Microsoft couldn't benefit from the cloud with the whole ecosystem of Microsoft SQL Server, the whole the server systems, the Office 365. I just felt they were late at the game. But then when Satya Nadella came in, and it was only Amazon at the time that was growing, I felt like, come on, Amazon will not be the only one that can do this. Yeah.
Right.
But then you have 2 comparisons, which are really interesting: Microsoft and IBM. IBM didn't pull it off.
No.
And that's really and this is really where you see then also what I think I would add to ROIC, what you mentioned is management quality.
Absolutely.
Yeah, because every business will come under stress at one point of time, and you will need to reinvent yourself. You will need to pivot, maybe split the business to really create shareholder wealth. And something, I don't know, sometimes you have that with CEOs, but with Satya, he speaks the right language, he gets it, and he was also bold in taking actions there. That's why I have a 7% yield. It's like, you can't predict that. It went beyond my imagination, of course, this growth,
Right.
they said. But to your point, there will some of those companies will still, even a few years before retirement, still be in your portfolio in the top. And those, from my experience, are typically the ones where you don't expect it from. The third company in my portfolio is Apfi, that I bought at $60. I knew it was undervalued, but would I know that they have Rinvoq and Scarigi coming up there as 2 blockbusters? No, of course not.
Yeah, that's awesome. And to add on to your point about management, I'm trying to recall the old Warren Buffett quote, but I think it goes something like, when you buy a company, you want it to be such a good company that even an idiot could run it, because sooner or later there will be an idiot running the company.
Steve Ballmer.
Yes,
did it.
Exactly. Microsoft didn't go anywhere. Not many stocks did from 2000 to 2010. And so, if your yield on cost on Microsoft is 7%, I can't imagine what your total return has been on that position. I bet that's been a huge winner.
I think it's a 10x.
Yeah. Doesn't surprise me a bit. That's awesome.
But I believe that there will be always a few stocks in people's portfolios if they focus a bit on quality. I mean, you will really not get it from the legal and general at this moment in time, I think. I mean, you will get growth. You can get to a 10% yield on cost, But if you're in the right kind of industry where the investments are happening, I wouldn't be surprised if there are a few companies that we don't think of today will really, really go 10x because of AI, not
Yeah.
because of being the ChatGPT of this world, but because of how they integrate this in their product, and it will blow everyone away.
Yeah, there's going to absolutely be instances of that. And, I've even seen, if you really dig into things, there's companies like Domino's Pizza who's partnered with Microsoft, and you see very, very little talk about that. But it will be interesting. How is even pizza making going to become more optimized with AI?
Yeah,
And I don't think anybody knows the answer to that.
exactly.
But that will be very interesting to see.
Yeah, but maybe pharma stocks. Yeah, imagine that someone really gets this algorithm and starts to really cure a certain cancer with a medicine.
Yeah, you're exactly right. There's still so many unknowns in regards to AI, and regulations and what's that going to look like. It's definitely the Wild West of investing right now. There's definitely been some stocks pulled up that maybe shouldn't have, and stocks that haven't been pulled up that probably should have. And 5 to 10 years from now, we're probably going to look back and be like, oh, why did I not think to buy this stock, or what was I thinking of this stock? And so, to go back to the top dividend growth stocks, if you want to make your life easier, which we should all be looking to do, start your portfolio with an ETF. And obviously that looks different depending on your location. If you're in Europe, I know you don't have access to the same things we do here in the US. But as a general baseline to get started, dividend growth ETFs, dividend growth ETFs, great place to start.
Cool. And then what about stocks that you don't own that you would like to own?
Stocks that I don't own that I would like to own. That's a great question. If you asked me a couple of weeks ago, I would have said ASML. And then I decided to start adding to that position the day before the earnings. And I was like, you know what, I'll dip my toes in the water, get a little bit, really hoping for, a sell-off after the earnings report. And of course, the stock goes up, which, is hypocritical of me to say, because I always say, if you're going to buy a stock and hold it for the long term, you shouldn't get too flustered by, the 2% movements or 5% movements at times over the short term. So mistake on my end, should have added more then, probably will add more in the future. But other stocks that I'd like to add to my portfolio that I don't currently own. Google is one that I've been watching. That starting dividend yield is so low, and we don't really know what management's approach to dividend growth is going to be. But they're using, I think, only around 10% of their capital to pay out a dividend right now. And, Google's kind of, from a valuation perspective, it's been probably the cheapest of the Mag 7 for the past year. And I do think there's huge opportunity there, especially from a total return standpoint. They've been in the news with legal issues, which has pushed down the stock some as well, but I don't think that's going to stand. So if you're looking for a total return stock, yes, they do pay a dividend. I think Google is a good option. I just couldn't tell you right now. Management hasn't told us enough about what their approach to dividend growth is going to be moving forward. I can tell you their ability to grow that dividend is very high. So if you have a long-term time horizon and you do want to look at them from a dividend perspective, it's not a terrible option. People have a hard time, understanding that in their head. But yeah, it'll be interesting to see from a dividend growth perspective what management tells us about their stock.
From a Google point of view, I own a few shares still. What is baffling me is how Google search compared to last year can still grow by 15% or something like that. They had 48 billion, I'm looking now, in revenue in 2023 and 54 in 2024. And I noticed that I'm using less and less Google search because of ChatGPT and all of this. They're still able to squeeze so much out of it. It's unbelievable.
Yeah,
but
that's a great point.
But the hidden growth gem, and that's why I think the multiple is compressed. I think many investors may think alike there, like how it's going to, because my philosophy, my expectation is that if they're not able to catch up with Gemini and everything, they may lose eyeballs, right? There. But then you see cloud growth going from 9 billion to almost 12 billion. It's a 3 billion as well. And I think that Google has really gold in its hands with the Google Cloud. The investments are starting to pay off the CapEx, because I think many corporates are very much under pressure, I think, with rising cloud costs. And the Google Cloud generally, I think, is cheaper than some of the others. And if you can integrate it with the whole Google suite and everything as a company, I think the business case over time will become much stronger to start considering cheaper cloud alternatives, where I think Google has a good offering. So I'm very curious and also bullish on the Google Cloud component here, but I'm not bullish on the search as such.
Yeah.
But then they grow it by 15% and 6 billion. I mean, I don't understand it anymore.
Yeah, that is really interesting. And one of the things I always think about, especially from the search perspective, is how much, is generated from ad revenue. They do have the sponsored stuff, but that can fluctuate a little bit from time to time when you go through bear markets. People pull back on advertising, but over the long term, I mean, 15% growth when people think AI is a threat, that's very impressive. Yeah,
exactly.
Very eye-opening.
Cool. So we might ask one more question before we get into the listeners' questions, because we have a couple of those to get through. And that would be, what advice would you give to your younger self, or to maybe someone who's considering starting to invest right now?
Yeah, that's a great question. My answer is simple. A stock is a business. We all struggle with that from time to time. When you see a stock like Palantir, which for the record, don't come after me, Palantir people. I'm not a hater. But when you see a stock like Palantir, you just see the stock ticker and you see that chart going up. And you think, oh, I think this might keep going up. Ask yourself, why do you think that? Are you just looking at numbers and a chart going up and down, or do you understand there's a business behind that? We have to understand every stock we buy is like a business that's, just across the street from us. Are they growing revenue? Are they growing earnings? Is that a business you'd want to buy? Do you like the location? Excuse me. Think of your local McDonald's. Is that a business you would buy? Would that be a good return on your investment? If I would have started thinking that way early on, it would have saved me a lot of pain.
Yeah, I think that's a great piece of advice, actually. I like that. So yeah, we'll move on to some listeners' questions, and we'll start with Pete's. First of all, he says, can you welcome him? So welcome, we've said that already, but he's asked, have you a catchphrase that you use in your videos?
I don't know if I have a catchphrase. That's a funny question, but I do know there's certain ways of saying things or terms that I've been told that I say too frequently, but it's just the way I talk. I can't help it. But if you come up with a catchphrase, I don't know if you can comment on the podcast. Let me know, and maybe I can see if I can throw it into one of my videos sometime.
We had Ryan here 2 weeks ago, and I think, what was his? Not too shabby.
Not too shabby.
You guys say
Not
that
too
in his
shabby.
videos frequently. That's funny. I'm sure people that watch my videos often, I'm sure could point out things that I say without even thinking about it. So I'm sure I do. I just can't think of it off the top of my head.
Yeah. Oh, when they respond and comment either on Facebook or to the Spotify podcast, we'll let you know.
I appreciate that. Thank you.
Tim has asked, what's the one piece of advice you would give your kids before handing your portfolio over to them?
I like the way Tim's thinking. He's thinking generationally. That's a really good question. Hopefully it's not just one piece of advice right before I hand over the portfolio. Hopefully it's a lifetime of advice, of teaching, like I said, stocks are businesses, teaching them why we can't be emotional investors. What's the history of the stock market look like? Focus on companies growing their earnings. The list could go on, but the reality is, I don't know if I could give one piece of advice that's going to grow capital for a lifetime. I think it's a lifetime of learning that allows you to continue to grow your capital for generations. So that's a really good question, and probably one we all need to think on more if we really want to think generationally. So I appreciate that question.
Yeah, it's good. I have my my oldest son, he's 14. he has his own portfolio. He picks all these companies himself. He's doing it for about 2 or 3 years now. And so he started quite young. And it's quite beneficial to him. He kind of ebbs and flows when he's interested, but he always comes back to it. He has actually a nice bit invested, whereas my younger son has no interest at all. At all. So it's kind of a different approach. But I think you're right. It has to be, if you're open and talk about it all the time, surely they will learn a little bit over time. And when they get old enough, they'll make their own mistakes, but hopefully we have to give them a good foundation. So that's my strategy with it anyway.
Absolutely. When you see the numbers on the screen actually go up and down, it changes your perspective a little bit and how interested you are in it.
Yeah, exactly.
So maybe one advice I can give, because The Richest Man in Babylon, this book,
Oh, yes.
it is all about this. So I think he gives his son, I don't know how much, but let's say $10,000, and then the son needs to I don't know, make it $20,000 in 10 years or something like that. So it's really like 7% growth over time. And of course, the son squanders everything and such. But it's really nice, and I think that's also what I'm thinking about. Like, no, God forgive that I don't die suddenly, yeah, right? But in generally, I think at a certain moment I will start giving my children some control to play it out, so that they get through their own learnings with some certain goals here. And I think this is what Buffett is also doing when you think about his management that he's been bringing in. Give them a small part of the portfolio, see how they do over the long term. And I think that's probably the best way, because then they really need to learn a process. They will lose, they will make mistakes, but they still do it in a controlled manner. And then you just need to live long enough so that they can actually really appreciate slow compounding, as an example.
I think that's very well said. I think the biggest lessons I learned were from my own doings and my own mistakes. That's a great point.
Yeah. Sebastian wants to know if you're buying more European dividend companies.
Yeah, great question. So right now I do have Louis Vuitton in the portfolio. Like I just said, I started adding ASML, but I do have to admit Evolution's been catching my eye lately. And when you look at the earnings growth and projected earnings growth, it is quite impressive. They do pay a dividend. It's a pretty decent yield right now. I think around 3.5%.
Yeah.
Europeans' dividend growth approach, like you mentioned earlier, is a little bit different from the American companies. So I don't know what to expect from that perspective yet. But that's definitely a stock on my watch list. I haven't done enough due diligence to pull the trigger on it yet, but it's one I've been reading about, doing more research with Seeking Alpha and Ticker Data, looking into that company. But that's one on my watch list.
It's what I can say, it's a founder-led business. It's of course in the online casino space.
Right.
It's really interesting. If you should just watch their products and see how it looks like. It's very enlightening. And I think a lot of the bull case is also in the US, in the States, opening up their legislation to allow for online gambling. So I think that's for most people the bull thesis. But they are struggling lately with the regulators, and also with, for instance, in Asia, hackers taking over the live stream and monetizing it, as an example. So that's where some of the operational issues are, and the regulative issues. And they also got some research going on by the UK government at the moment, where they are at risk potentially losing the license, but it's only like a few % of the revenue. So, and losing the license would be the most extreme, potential outcome of this, which I think management is a little bit more relaxed under.
Right. That's well said. I appreciate you sharing that. And I think it's a quick reminder that one of the most important skills, if you're going to be an active investor, is being able to look at the news and determine, is this a short-term or long-term headwind?
Yeah.
So, something to think about.
Okay. Vladimir has asked about using a personalized ETF for tax efficiency. So apparently companies like Schwab will allow you to create your own ETF. It has structured fees of around 0.35%, with all trading costs included in the expense ratio. He says that it is a little bit nuanced and has its limitations, but is it something you've come across?
I haven't I do believe I might have heard this mentioned before, but as far as I'm concerned, when I'm buying stocks in my portfolio, I am running my own ETF. It's the Dividendology ETF already. So I prefer just to avoid the fees altogether and manage my own portfolio. With that being said, obviously I do have SCHD in my portfolio, an ETF that does have some expenses involved, nothing too high. But I'd encourage you, if you're going to be buying stocks and being an active investor, you can avoid the fees altogether just by managing things on your own terms.
So Lucian watches all your videos, but he wants to know your opinion about BDCs.
That is funny. I plan on discussing BDCs here a little bit more in future videos. So BDCs, business development companies, they focus on providing financing typically to smaller to middle market companies, typically have higher than normal starting dividend yields. And like REITs, they're also required by law to pay out 90% of their earnings in the form of dividends. So that does limit the growth of these investment vehicles. And I'll start by saying there's a lot of really bad BDCs out there, but that doesn't mean there's not opportunities. Obviously, the most popular one that we typically see is Main Street Capital, stock ticker MAIN, and they've done really well over the past year. I don't remember how much they're up off the top of my head, but the starting dividend yield is around 6.5%. And I believe they're up about 20%. Now, obviously, it doesn't say anything about the actual underlying fundamentals of the company, but they pay out dividends on a monthly basis. And if you read their investors presentation and look at those dividend payouts, they actually consistently pay them out and grow those dividends. And on top of that, when they generate extra income, which is typically what happens when you're in a high interest rate environment for these BDCs, they pay out special dividends. So they've paid out a lot of special dividends over the past year. So with that being said, those type of investments, very sensitive to interest rate environment, something to be aware of. So there is opportunity there. If you're a long-term dividend growth investor, it might not be something you want to explore until you get a little bit closer to where you're looking to maximize income per se. But with that being said, there's always opportunities to explore. Again, Main Street Capital is a good one to start with. Always consider valuation and things of that sort as well in the macroeconomic environment, because obviously interest rates are projected to go down over the next year.
JVDK has noticed that you mostly have low yielders with more growth, as you mentioned before. But is this because you're younger? And if you're in your mid-40s, would you still have the same approach?
Yeah, great question. We've touched on this quite a bit today. It is because, regardless of age, I consider myself a long-term investor. I want to maximize dividend income over the long term. So yes, I want to focus on the growth and the dividend growth element. Now, if I was somebody who, let's give an example, I'm looking to live off dividends by the time I turn 50 on the dot. If I'm 40 years old, that is around the time I'm going to start focusing maybe on the mid yielders, maybe around the 3% starting dividend yield. That's also going to give me, like you guys mentioned, the Chowder rule, maybe have a 6 to 7% dividend growth rate. There's a dividend growth pyramid that we all have to have in our minds, and we have to pick out, where are we on that dividend growth pyramid? How close are we to living off dividends? Because once we get closer to the top, we start not being quite as concerned with the dividend growth. We start being more focused on the dividend yield. Now, obviously, it always has to be sustainable, and dividend growth needs to be above the rate of inflation. But he's right. As you get older, get closer to living off dividends, you should have more of a focus on yield. So yes, strategy should change over time.
Cool. And then the last question is from Arkaduz, and he's asking, what is your opinion, the fair value for SCHD, and what is your expectation about their dividend increase in the next decade?
Yeah, that's a great question. I'll start with the second part in regards to the dividend increase over the next decade. 2010 to 2020, we obviously operated in a very low interest rate environment, and there was money being printed into, our economy, which definitely helped spurt some growth. With that being said, I still expect SCHD to have really good dividend growth over the next decade. I think 10% is well within reason due to their methodology. But if we enter a 3-year bear market, like the .com bubble, for example, it would be really interesting to see what happens with SCHD from a dividend growth perspective. And with that being said, if we do enter a time period like that, SCHD is still something I would want to hold. I would say it's very likely to outperform in that scenario from a total return perspective, even a dividend perspective. Now, I don't necessarily expect that to happen. We'll have plenty of down years over the next decade. But SCHD has given us every reason to continue to expect to see very high levels of dividend growth, likely double digit. Maybe there'll be some fluctuation, but if we look at the past, I think 11 to 12 years that SCHD's existed, nearly every single one, you're looking at least 9% plus dividend growth. So I don't think it'll vary too much. Maybe a little bit lower, but not enough to be any concern. Now, when we talk about fair value for these ETFs, it's very difficult to work with intrinsic value when it comes to ETFs because you're talking about a basket of stocks. And in the case of SCHD, obviously they have their annual reconstitution every March where they're kind of mixing up the stocks in the portfolio, the allocation of those stocks. So from a valuation perspective, you really can't value an ETF like SCHD. What you can do is figure out where we are in the market. Obviously, stocks right now, from a price to earnings perspective, quite a bit more expensive, at least over here in the US, than they were, 3 to 4 years ago. With that being said, if you're a long-term investor, I wouldn't let that stop you from buying into ETFs. Buying or dollar cost averaging has proven to be a really effective strategy over the long term. So I wouldn't get too worried, especially when it comes to ETFs, with just trying to buy in at what you feel like is the perfect time.
Yeah, makes sense. We don't have that problem in Europe because we can't buy SCHD. So we look on with jealousy. So yeah, that was the last question from our community. So thanks a lot to all the guys for asking that. But we do have this new segment around our community DGI portfolio. So what we've done, so in case all of our listeners are not aware, on our Facebook group, on our Twitter groups and our social media, we asked all of our community members to pick the top 10 dividend growth stocks to put into our portfolio. So I'll list out the 10 that we have. We got Visa, Microsoft, Johnson & Johnson, Realty Income, Coca-Cola, L'Oreal, Shell, Agree Realty, Louis Vuitton, and British American Tobacco. So what we plan on doing is every time we have a guest on the show, they have to remove one of these stocks and replace it with a company from their own. So you're the first person that has the pleasure of doing this. So I'm quite interested to hear what you will remove and why, and what you will add.
Yeah, well, I feel honored to be the first on the list. I hate to put one of these off. I'm looking at the list, and I'm a big fan of quite a few of them. Obviously, I see Visa, Microsoft on here. We've touched on them enough, but I see Agree Realty Corporation. That's a REIT. It's considered the little brother of, the all-time famous monthly dividend payer, Realty Income.
Yeah.
I think their starting dividend yield right now is about 4%, and dividend growth is close to about 4% right now. So that's a good combination. We see, staple companies like Johnson & Johnson and Coca-Cola on the list. So yeah, I'll be interested to see how this evolves over time. If I had to make a change, here's what I would do. I'm going to go pretty heavy on the dividend growth side since we already have Visa and Microsoft on here. I'm going to remove, let's see. Let's say we remove Coca-Cola and replace it with ASML. So obviously Coca-Cola, I consider it a more defensive dividend stock as of right now, starting dividend yield a little bit above 3%, and dividend growth is around 3 to 4% as well. Use most of their capital to pay out dividends, very mature business. By taking it out and throwing ASML in, you are giving up some immediate dividend income. You're giving up some dividend yield, but you're really rejuvenating the portfolio with a lot of growth potential and a lot of dividend growth potential over the next few decades.
Wow. Yeah. Do you know what? I was surprised that ASML was not on this list in the first place, particularly in place of maybe British American Tobacco or Coca-Cola. I thought ASML might make this, so I think that's a solid choice.
Thank you. I appreciate it.
What do you think, European DJ?
For me, Coca-Cola would be also first one I would kick out. I don't have that association or this feeling for Coca-Cola. I always find it like 3% no growth. That's kind of in my mind. I know that people look at the return on invested capital. We had Alberto here and Eloy Snowball in the past, big fans of Coca-Cola. I just don't see it. If you add it up, you're like talking about 3% yield, almost a 4% 5-year CAGR. It's like 7%, and then then I will go definitely for others. And ASML gives me much more joy thinking about it.
I think Coca-Cola, there is a place for certain people in their portfolio if you consider yourself very defensive, looking for predictable cash flows. But if you have any risk tolerance whatsoever, I'd encourage you to look around a little bit more.
Yeah, exactly. And for me, it's almost like a bond, Coca-Cola.
Yeah. And I will say, I think 2020, I actually had some Coca-Cola in my portfolio because the valuation was so good. And I'm up pretty big on the position. But now that I think about it, and it is something I've thought about, opportunity cost is a real thing.
Yeah.
Do I move out of that position and put it into something else? The answer is honestly probably yes, something I should look at closer.
I could consider Coca-Cola at a 6% yield. Yeah, but not at a 3% yield. That's for me, like, there needs to be more yield compensated for the slow growth here.
Yeah, agreed.
Good, thanks. Well, we'll update this list with ASML instead of Coca-Cola, and then we'll see what the next one does. I was glad you didn't kick Shell out, because that would really, well, no pressure to the next one either, but Shell is definitely something that I expect people to kick out, but I hope it will stay. Yeah. How about you, Derek? You're quiet on this one.
Yeah, Coca-Cola would definitely have been my first out. But likely, if I look at the quality of companies we have on that list, I'm surprised British American Tobacco is there in terms of quality. I think it's the lowest of that list. So let's see. I have British American Tobacco. I have quite a bit invested in them. But man, you can't compare them to the likes of Visa, Microsoft, Johnson & Johnson. It's just, they're not in the same caliber. So let's see. So Eli, that's the end of the show. So thank you so much for joining us today. It was great to meet you virtually in person. I watch your videos quite a bit, but I hope you enjoyed it as much as we did.
I had a great time, guys. I appreciate you guys for letting me on. I appreciate all the listeners. It was a great show. Thank you guys again.
Okay. And to our listeners, thanks again for listening. Thanks for all your questions, and we will see you all next week.
Right.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.